Lou Vassanice joins us right now, the Public Ventures President, Chief Market Strategist. We've also got Aaron Gibbs, the Main Street Asset Management CIO. So, Aaron, what are you expecting?
25 bips. I'm with the consensus. I'm not going to go out on a limb here. I think we're looking at 25 bips. I think we're at
basis points.
Yes, basis points. Yes. So definitely
you guys are always so cool with that, the bips, and I thought, oh, maybe I should.
1/4 of 8%.
Okay. But would that be it?
Right now, looking at, as we just saw the jobs report, looking at wage growth. And so we saw about 1.3, almost 1.5% wage growth in the first quarter of this year, just on the back of 1.1 in the fourth quarter of last year. So that means that even though we're hearing numbers about layoffs, we're still seeing wage growth keep come up.
Yeah, this ADP thing was like off the charts.
Exactly. Yeah. And so until the growth stops, I think the Fed could remain aggressive. We really need to see wage growth sort of stabilize in order for the inflation numbers to start coming down and for the Fed to back off.
Got it. Lou, we were talking about that ADP jobs report, private payrolls, almost 300,000 in the latest period. So you could extend this to say, all right, maybe it isn't, hike in May and go away. Maybe, given a strong report like that, the Fed sort of couches it. What do you think?
Yeah, no, I think they're going to take a very aggressive stance because the labor market's key, right? Until we bring the labor market under control, inflation is only one side of the equation. So I think definitely 25 basis points this meeting. I think we get another 25 basis points in June or July.
Really? Okay.
And I think the greater fool theory at work here is everyone thinks that Powell's the foolish one. I'm going to tell you investors are foolish right now because the market is still pricing in 2 rate cuts before the end of the year, which I think
still really?
Yeah, it was the latest data today out of CME Group. Look, that's a banana peel waiting to step on. Right? Never. I mean, if it does happen, we're in a really bad place because that means the Fed had to move very swiftly.
How do people who bet on Fed fund contracts and the rest of that the rates will start heading down to the end?
They're pricing in 2 rate cuts before the end of this year, which I just think is it makes zero sense. And if that becomes reality, I think there's some other shoe that's going to drop that's going to cause the Fed to do that. It's going to have to be severe change.
Banking comes up, that we could have more bank troubles. Right. What do you think?
Something like that. Yeah, I think the idea of having rate cuts, I would love to see just stabilization, but the idea of actually them cutting before the end of the year, because we know it sort of takes like 6 months to process these hikes or a cut.
Yeah.
I mean, that would mean that we're facing either an increased banking crisis or some type of real recession.
Are you guys surprised that I've called it a slow-moving train wreck, these bank announcements, that nothing with the speed and the sweeping nature of the bank failures and the meltdown, but almost one every day. Now, of course, a lot of these issues are coming back today, but again, it gyrates wildly. What do you make of where we are with the whole banking thing first, Luke?
Yeah, look, I think the first shocks are always the most jarring ones. You saw the biggest bank, Silicon Valley Bank has the most exposure, very niche, and now we're starting to see some knock-on effects where deposits are moving.
Yeah.
I think the next potential risk is in the commercial real estate market. We're starting to see that. But look, you got to look at the regionals that have a lot of exposure there. But if we start looking at size of assets, these regional banks, I don't think they're going to carry the rest of the market down. They don't have enough weight. Now, if we flip to tech and it's an Apple or a Microsoft disappoints, that's a huge weight on the
But people like Charlie Munger were concerned about that, and Elon Musk are concerned about the commercial market and all that. Even the biggest, most pristine banks have a lot of exposure to that. Their very buildings are their exposure. Should we be worried?
I would say for the large banks, the big diversified, even though they have a lot of exposure to commercial, their ratios are nothing like what we saw in 2007, 2008. They're much in a stronger place when it comes to writing off debt, their ratios and that type of thing. So I think, yes, it certainly could take a hit. I think this is something that we're going to be talking about for several months. I don't think it's going to go away immediately, but so far we've been pretty good at handling one crisis, dealing with it, letting it roll out over the next 2 to 3 weeks, handling the next crisis. And just the fact that the ratios in general for most of the larger banks are very good and much stronger than we've ever seen before, and have a lot of cushion in being able to deal with bad debt. I think that one is going to be weathered through, but certainly it's not an area I want to invest in.
But it feeds off itself, right? I had a friend of mine, he's actually quite wealthy, not you guys type wealth, but you guys wouldn't even offer him.
We have good marketing, That's all.
But no, in all seriousness, he's been very happy at the mid-sized regional bank. It's a well-known name. I don't want to besmirch it or potentially, but he wants to pull his money out because while he's had no problems there, he thinks, I think I should be at a big bank, a big money center
Right.
bank. And I wonder, extrapolating that, how many more of that are of that mindset, and this feeds on itself.
Absolutely, and I think this is what we're going to see over the next several months. It's going to take a while for people to move their assets because, this problem is really about moving your cash from one bank to another. It's not about it completely disappearing. And so I think investors, as they shift, as they diversify and say, okay, I want 1/3 of my money here and 1/3 of my money here, that is going to take until the end of the year where we really see that complete settling of, okay, I'm comfortable and I'm stable with where my assets are. And maybe I even move it to Deutsche Bank. Maybe I move it to, outside the U.S. And so, again, that's just an area I would not be investing in because I think there's so much certainty and it's going to take a while for people to really get comfortable with where their assets are.
A lot more volatility ahead in the banking sector for sure. I think you're also going to see, from the commercial real estate side, look for a really strong push to return to work, to return to the office. Not because people think that COVID's over and that's what we should do. It's because they need occupancy rates to be higher to preserve those commercial real estate loans and
People
buildings.
are still fighting it.
And people
right?
are fighting it, and I'm just telling, I'm seeing it. Some of my contacts in the commercial real estate industry came out of conferences and said that was the main topic: get everyone back in the office.
Easier
Doesn't matter
said
what
than
it takes.
I'm not even
Yes.
here. I'm a hologram. I'm not even here myself. Or I don't wander too far, guys, because I want to pick your fine brains a little bit later to get a read, for example, on some of these other things like oil.